Hey everyone, welcome back to Corporate Decoder. Today, PRPH just filed their 2025 annual report, and I am seeing some serious red flags about their ability to stay in business. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is facing massive financial challenges, and their latest report makes it clear they are fighting for survival. So ProPhase Labs, a company aiming to be in biotech, genomics, and consumer products, just dropped their 2025 annual report. Now, normally we dive deep into the numbers, but this filing screams trouble. Right off the bat, the financial statements themselves have a huge warning, going concern. This basically means the company's own auditors have serious doubts about whether it can survive for the next year. This is like a doctor telling you a critical surgery might not be survivable. Let's look at their cash. On the 31st of December 2025, they had only $90,000 in cash. That is less than $100,000 to run a whole company. For comparison, a year earlier they had $678,000. That is a massive drop. And how much did they lose in 2025? A stunning $14.7 million. The year before, it was even worse, a $53.4 million loss. They are burning through money at an alarming rate. Their liabilities are through the roof. In 2025, their total current liabilities were $53 million, up from $32 million the year before. That means they owe a lot of money to suppliers and others, and they have very little cash to pay it back. Their accounts receivable, which is money owed to them by customers, has also taken a hit. It went from $20 million in 2024 down to just $1.5 million in 2025. This might sound good, but it is likely because they stopped doing a lot of their diagnostic testing business. Remember their diagnostic services business, especially COVID testing? They've essentially stopped that. The report says they ceased operations in the fourth quarter of 2024 and officially deconsolidated those subsidiaries in September 2025 because those subsidiaries filed for Chapter 11 bankruptcy. This is a major blow, as that was a significant revenue stream. Their consumer products business also saw revenue drop significantly from $6.8 million in 2024 to $4.3 million in 2025. They mentioned refining their focus and reducing sales of their TK supplements. And guess what is growing? Their unallocated corporate expenses, which includes things like interest on debt, went from $15.6 million in 2024 to $14 million in 2025. Even with cost cutting elsewhere, interest payments are a huge burden. Their interest expense nearly doubled from $3.4 million in 2024 to $6.9 million in 2025. This is a direct result of their mounting debt. They are paying more just to borrow money, which is a bad sign. In their management discussion, they are very clear about their struggles. They talk about significant liquidity constraints and operating challenges. They've lost access to certain capital sources, like at-the-market offerings and equity lines of credit. Their stock is no longer on the Nasdaq and is now traded on the OTC markets, which makes it harder to raise money. Interestingly, they reported a debt extinguishment gain of $838,000 in 2025. This usually happens when a company pays off debt for less than what it owes, often a sign of distress. The bankruptcy filing by their diagnostic subsidiaries in September 2025 is a huge event. It means those parts of the business are no longer under the company's direct control and are being reorganized under the court. Any money the company might get from them is uncertain and subject to bankruptcy laws. They've been trying to raise capital by selling stock, but with the stock price so low, even after a 1-for-10 reverse stock split that happened in December 2025, it is a tough sell. When they sold off their Pharmaloz manufacturing business in January 2025, they got rid of a lot of assets and liabilities, but it also meant losing a revenue stream and recognizing a gain from the sale, which painted a slightly rosier picture than the reality of their ongoing operations. Even the auditors are sounding the alarm. They've included a going concern paragraph in their report. This is a major warning sign. Historically, companies with going concern warnings often struggle to recover, and many end up delisting or facing bankruptcy. Think about companies like Bed Bath & Beyond or Rite Aid, which faced similar situations before their major troubles. For a company in this state, a $1,000 investment could easily become worthless within a year. On top of all this, their internal controls are not effective. This means there are weaknesses in how they track and report their financial information, which can lead to errors or even fraud. This is another big red flag for investors. So what is the story here? ProPhase Labs is in a very precarious financial position. They're burning cash, have massive debt, and their auditor has serious doubts about their survival. The bankruptcy of their diagnostic subsidiaries and the significant drop in revenue are major concerns. They are pinning their hopes on new financing and cost cutting, but with such limited cash and high debt, The odds are stacked against them. My biggest concern is their survival beyond the next year, given the going concern warning and the extremely low cash balance. What I am actually looking for is a clear path to profitability and a significant reduction in debt, which seems very unlikely right now. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis valuable, please like, subscribe, and check out our Discord for more discussions.